The Fed just admitted they're powerless. Here's what happens next. What if the very architects of our financial system are navigating a catastrophic storm with a broken compass? Imagine a central bank, tasked with maintaining economic stability, admitting that its primary tools are not only ineffective against the core drivers of inflation, but are actively steering the economy towards a cliff. This isn't a hypothetical scenario. It is the unnerving reality we face today. The public discourse is a carefully managed theater, with one side blaming geopolitical events and climate policy for every economic pain point, while the other side attempts to extract truthful answers from officials who are masters of evasion. We are witnessing a systemic breakdown of transparency, where the truth of our economic fragility is being deliberately obscured from the very people who will suffer most when it shatters. The central problem is an inflation that has been misdiagnosed and mistreated, much like an illness where the medicine causes more harm than the disease. The Federal Reserve finds itself in an impossible position, publicly claiming to have the situation under control while privately knowing it has no influence over the primary drivers of rising prices, such as energy supply shocks and persistent supply chain disruptions. The political theater surrounding this crisis is almost comical in its absurdity. We see politicians attempting to corner the Fed chair into blaming foreign adversaries for inflation that was brewing for well over a year before any invasion, a clear attempt to deflect from domestic policy failures. The truth is that the seeds of this crisis were sown through unprecedented monetary expansion long before they found a convenient scapegoat. The Fed's only real tool, raising interest rates, is a blunt instrument designed to curb demand by, in effect, making the entire population poorer. The strategy is to slow the economy, which translates directly to job losses and diminished investment. This was laid bare in a stunning public exchange, where Senator Elizabeth Warren accused the Fed chair of risking a recession with millions out of work, effectively highlighting that the cure for inflation is to intentionally induce a painful economic contraction. She exposed the terrifying reality that the Fed's playbook is limited and destructive, capable of tipping a fragile economy into a full-blown recession without actually fixing the underlying inflationary pressures. This public confrontation was a rare glimpse behind the curtain, revealing the Fed's profound impotence. The catalyst for the next phase of this crisis is the Federal Reserve's continued commitment to its monetary tightening program, even as the foundations of the economy begin to crack. The political pressure to reverse course will soon become unbearable. This pressure isn't just coming from senators in televised hearings, it's building from within the system. The Fed governors themselves, particularly those representing regions heavily reliant on agriculture and industry, are witnessing the direct, damaging impact of higher interest rates. Farmers who operate on borrowed capital are seeing their financing costs skyrocket, threatening the very core of our food supply chain. This is a microcosm of the nationwide squeeze, where rising rates are choking off the capital needed for businesses to operate and grow. The Fed chair's response to these legitimate concerns is a masterclass in detached deflection, essentially framing these severe sectoral problems as unfortunate but necessary collateral damage. His implicit message is that it's not my problem, a chilling admission from the one person tasked with stewarding the nation's economic health. The only positive metric the Fed can cling to is the employment rate, but this is a notoriously lagging indicator. It's the last domino to fall. By the time the unemployment numbers begin to plummet, the damage will already be irreversible, cascading through the real estate market and other critical sectors of the economy. They are driving by looking in the rearview mirror, oblivious to the chasm opening up just ahead. The tipping point will arrive when the lagging indicator of employment finally breaks. A sharp rise in unemployment will signal that the recession has truly taken hold, triggering a domino effect across the economy. The real estate market, already teetering under the weight of higher mortgage rates, will face a collapse as job losses eliminate purchasing power and force distressed sales. At this moment, the political pressure on the Federal Reserve will transform from a steady stream into an overwhelming flood. The calls to do something will be deafening, and the very politicians who once demanded tighter policy to fight inflation will now demand a complete reversal to save the economy from the depression they helped create. This forced pivot will be the critical event where the change becomes irreversible. The Federal Reserve will have no choice but to abandon its tightening program and revert to what it does best: printing money. We will see a return to quantitative easing on a scale that will dwarf previous programs, coupled with a frantic slashing of interest rates back towards zero. However, this will not be a return to the pre-crisis status quo. It will be an act of desperation, an attempt to reflate a system that has fundamentally lost credibility. Injecting trillions of newly created dollars into a contracting economy suffering from supply-side constraints is the classic recipe for an inflationary depression, a toxic cocktail of high inflation and severe economic stagnation. To understand the impact and aftermath of such a scenario, we must look to history, specifically how tangible assets like gold and silver have performed during periods of profound economic distress and monetary failure. The run-ups in the late 1960s and early 1970s were a direct result of the breakdown of the Bretton Woods system, culminating in President Nixon closing the gold window in 1971. Letting gold float freely against the dollar was a pivotal moment. It severed the last link between our currency and any form of tangible value, unleashing decades of credit expansion and monetary manipulation. This event was a major catalyst for countries like South Africa to begin minting Krugerrands in massive quantities, correctly anticipating that gold was about to become the de facto currency in a world of floating fiat. During that era, if you wanted to own physical gold, the Krugerrand was often the only readily available option. The decision to untether the dollar from gold was crucial because it prevented a complete drain of the United States gold reserves. Foreign nations holding vast quantities of U.S. dollars from post-war arrangements and arms sales were lining up to redeem those paper notes for real gold. The alternative to floating the price was to honor those commitments and effectively sell off the nation's entire gold stock for rapidly depreciating paper currency. This historical context is vital. It shows that when a monetary system is under existential threat, the value of unprintable, tangible assets becomes undeniable. The recession of the early 1980s provides another critical lesson. The Carter administration's high spending and the resulting runaway inflation led to a period of extreme monetary tightening under Fed Chair Paul Volcker. This era saw interest rates climb to unthinkable levels. I recall personally receiving a credit card statement with an interest rate of 36.99%. A rate that even a loan shark might have considered excessive at the time. This economic chaos was the backdrop for one of the most explosive bull markets in precious metals history. In 1980, gold soared to over $800 per ounce, and silver rocketed to nearly $50 per ounce, a price level that, in inflation-adjusted terms, has scarcely been seen since. The silver-to-gold ratio during that 1980 peak approached the historic, albeit somewhat archaic, 16-to-1 ratio established in the 1790s. While the ratio itself was more of a historical touchstone than a driver of the market, it demonstrated the sheer speculative fervor and flight to safety that gripped investors. People were desperately seeking a hedge against a currency that was rapidly losing its purchasing power. This wasn't just a niche market for gold bugs, it was a mainstream panic. The events of 1980 proved that during a crisis of confidence in government and central banking, gold and silver do not just perform well. They can undergo parabolic price increases as their role shifts from a simple commodity to a monetary asset of last resort. More recently, the aftermath of the 2008 global financial crisis offers a modern blueprint for what we might expect. The crisis began with the Dow Jones reaching an all-time high of 14,000 in 2007, only to be cut by more than half, bottoming out around 6,500 in March of 2009. Throughout this period, the Federal Reserve consistently assured the public that the subprime mortgage crisis was contained and that everything would be fine. This was a catastrophic misjudgment that shattered the Fed's credibility. The ensuing chaos and the massive government bailouts that followed created a perfect storm for precious metals. The run-up in gold and silver prices in 2011 was a direct consequence of the 2008 crisis, and the unprecedented monetary response. As people struggled to regain their footing and hesitated to re-enter a stock market they no longer trusted, vast amounts of cash were diverted to safer alternatives. Gold seemed like the most logical safe haven, and silver, with its dual role as both a monetary and industrial metal, looked to have a bright future. Gold reached over $1,900 an ounce, and silver once again challenged its 1980 high, touching $49.50. This rally was a clear vote of no confidence in the policy of bailing out failed institutions with trillions of newly printed dollars, a policy that socialized losses while privatizing profits. We are now facing a situation that I believe will dwarf the 2008 crisis. This will not be the Great Recession. It will be the Greater Recession, a massive inflationary depression. In such a scenario, gold and silver will not be sitting on the sidelines or trading in a narrow range. When a crisis of this magnitude hits, a fundamental repricing of all assets occurs. The key difference between now and previous recessions is the sheer interconnectedness of the global financial system. In the past, markets were more siloed. Today, everything is linked in a complex and fragile web. Consider the stock market crash of 1987. Back then, there were no massive hedge funds dominating trading volumes. The primary investor was still the individual. The crash was largely driven by a cascade of individual investors getting spooked and selling in a panic. The system was simpler. Today, the market is a single club. The Federal Reserve, the U.S., Treasury, the major investment houses, and the hedge funds are all intertwined, operating with a level of coordination and using financial instruments of a complexity that was unimaginable in 1987. This interconnectedness means that a crisis in one corner of the system can now trigger a global contagion almost instantaneously. Another critical difference is the nature of our national debt. In previous decades, the U.S. government held longer-term debts. Today, our debt structure is dangerously skewed towards the short term. We are constantly rolling over massive amounts of debt at ever-increasing interest rates. We are no longer in a position to even pay the interest on our debt with incoming revenue, let alone pay down the principal. This is a classic sovereign debt crisis in the making. The political rhetoric around this issue is pure fantasy, with presidents claiming to reduce the deficit simply because they asked for a $3 trillion spending package and only got $2 trillion. This is not fiscal discipline, it's political math designed to deceive. This brings us to the inevitable policy response. I predict that by the end of this year, the Federal Reserve will be faced with such massive recessionary pressure that it will be forced to reverse course. This won't be a simple tapering or a modest adjustment. It will be a return to quantitative easing on a scale we have never witnessed before, a fire hose of liquidity aimed at a burning building. The truth is they likely never truly left quantitative easing. They simply found new names for it and obscured the data. The budget numbers being discussed every cycle are astronomical, confirming that we are on an unsustainable path where the only solution offered is more debt. The political will to implement the harsh, painful measures required to restore fiscal sanity is completely absent. No politician, regardless of their party, will have the courage to do what is necessary. The pain threshold to do the right thing is now so high that it is politically impossible. Even a president like Donald Trump, who understood business, was ultimately bribed by Congress into accepting massive omnibus spending bills in exchange for funding for his own pet projects. He fell for the classic Washington trap. The system is designed to perpetuate spending because every politician's primary goal is re-election, which is achieved by promising benefits, not by demanding sacrifice. This political paralysis leaves the taxpayer holding the bag for a generation of fiscal irresponsibility. The prevailing mindset in Washington, particularly among progressive politicians like Elizabeth Warren, is that there is always more money. Where does it come from? It comes from the printing press and, ultimately, from the debasement of the savings and wages of the American people. They propose solutions like raising gas taxes to cover deficits caused by a lack of tax revenue, a circular logic that only serves to further burden the productive economy. There is no resistance to this cycle because the entire system is captured by this one-club mentality. Looking forward, the future for gold and silver in this recessionary and likely depressionary environment is extraordinarily bright. I remain surprised that the paper markets like the COMEX have been able to maintain control over the silver price for this long, but I believe they will be forced to relinquish that control. The physical demand will eventually overwhelm the paper supply. When that happens, the institutions that hold all the cards will simply do what they always do. They will change the rules. If regulations require them to hold a certain amount of physical silver in reserve against their paper contracts, they will just lobby to have those regulations changed or eliminated. This is the ultimate moral hazard of a system where the players can also write the rulebook. However, even changing the rules cannot conjure physical metal out of thin air. The disconnect between the paper price and the price for real physical metal in your hand will continue to grow until the paper market becomes irrelevant. We are already seeing this divergence in the premiums required to acquire physical bullion. This is the market sending a clear signal that the emperor has no clothes, that the paper promises are not trusted, and that a massive repricing is inevitable. In this environment, the very nature of money is being called into question. As confidence in the U.S. dollar and the government's ability to manage its finances continues to erode, people are increasingly looking for alternatives. We are witnessing a grassroots movement back towards sound money. More and more people are choosing to conduct business and settle debts using precious metals. I have been accepting gold and silver as payment for work for over a decade, and it has allowed me to build a significant stash of real wealth outside of the formal financial system. This is not a fringe activity anymore. It is a logical response to a failing system. The act of bartering with silver and gold is the ultimate expression of no confidence. It is a declaration that you trust a 1-ounce silver coin more than you trust the full faith and credit of the government that issues the currency. This trend will only accelerate as the crisis deepens. People are realizing that digital money, while convenient, is ultimately a tool of control. Real money, tangible money that you can hold in your hand, offers a degree of freedom and security that a digit in a bank account simply cannot match. It is dirty, it is heavy, and it is honest. The arguments against this thesis often come from those with a blind faith in technology and government. The push for electric vehicles is a prime example of this ideological disconnect from reality. The claim that electric cars will solve our climate problems is a dangerous fiction. The carbon footprint required to manufacture an electric vehicle, particularly the battery, is immense. Every electric car has a greater life cycle carbon footprint than its gasoline-powered equivalent. This is an inconvenient truth that the climate lobby refuses to acknowledge because it undermines their entire narrative and their quest for control and subsidies. They ignore the fact that natural causes of greenhouse gases, such as volcanoes, swamps, and peat bogs, dwarf the emissions from all forms of human transportation combined. The solutions they propose are not rooted in science, but in a political agenda. If the goal was truly to reduce emissions from transportation, we would be reinvesting in proven technologies like electrifying our rail systems, not forcing consumers into expensive electric cars that shift the pollution from the tailpipe to the power plant and the strip mine. This is yet another example of a top-down, politically motivated agenda that ignores economic and physical reality. Ironically, this misguided push for a green transition is incredibly bullish for silver. Solar panels, electric vehicles, and countless other electronic components require massive amounts of silver. This creates a powerful dynamic where industrial demand is set to explode at the exact same time that investment demand is surging due to monetary concerns. This dual pressure on a relatively small market is a recipe for a historic price squeeze. The forces of government policy and the forces of market fear are converging on silver, creating a once-in-a-generation investment opportunity. As we look ahead, the immediate future appears volatile and dangerous. The markets for precious metals are hot, with demand for popular items like 1-ounce silver buffalo rounds and various silver bars far outstripping the available supply. We are seeing inventories depleted in a single day, a clear sign that the public is waking up to the risks we face. This isn't just institutional buying. It is a broad-based movement of individuals seeking to protect their wealth from the coming storm. The demand is relentless and growing. The takeaway from this analysis is not one of fear, but of preparation. The financial landscape is undergoing a seismic shift. The era of unquestioned faith in central banks and fiat currencies is drawing to a close. The interconnected, debt-saturated global financial system is more fragile than it has ever been, and the political will to enact necessary reforms is non-existent. The government and its monetary plumbers are out of tricks. They can only create larger messes in their attempt to patch the leaks in a system that is fundamentally broken. In this new landscape, the historical role of gold and silver as ultimate stores of value and hedges against systemic collapse will be reasserted. The coming inflationary depression will not be a repeat of 2008 or the 1970s. It will be a unique crisis born of our modern era of unprecedented debt and global interconnectedness. The run-up in precious metals will not be a mere rally. It will be a fundamental repricing against failing paper currencies. The shift is already underway, visible not in the manipulated paper prices, but in the soaring premiums for physical metal and the growing trend of using it as real money in everyday transactions. The lesson, therefore, is to understand the history of money and to recognize the patterns that are repeating today. When governments abuse their privilege to print money, the value of that money inevitably declines. When financial systems become too complex and leveraged, they inevitably collapse under their own weight. In these moments, wealth does not disappear, it simply transfers. It transfers from those holding paper promises to those holding tangible assets. The choice before every investor is to decide on which side of that great transfer they wish to be. History provides a clear and unwavering guide for those willing to listen.